let's now pivot and start talking to the Australian data. We've obviously got a lot to talk about here. Now, because effectively the Australians have long summer holidays, but we also have this 65-day protocols where GDP numbers, we're not going to get them until the early part of March. So we can't report on GDP results for December. So let's move straight into inflation before we announce what the RBA did with rates today. So in terms of the inflation story, we saw Australia's inflation rate was at a reading of 4.1% year on year in quarter four, and that's down from 5.4% in Q3. And it was a really good result in terms of, because market expectations had it at sort of 4.3%. Now, this was the lowest figure since Q4 of 2021, as goods inflation eased further for the fifth consecutive quarter, so a reading of 3.8% versus 4.9% in Q3. And services inflation, this is the one we've been talking about at the end of last year, everyone. That service inflation is slowing. And we saw that slow for the second straight quarter from 4.6% to, reading of 4.6 down from 5.8%. So that's the big ticket item that we want to see in terms of that domestic demand-led services inflation. So inflation moderated for food, 4.5% versus 4.8, housing 6.1 versus 7, health 5.1 versus 5.4, transport 3.7 versus 5.6, recreation and culture 0.5 versus 5.6. So a big drop there. Yeah. Education 4.7 from 4.8. Insurance and financial services still growing at a huge clip here. So inflation is still running at 8.1%, but compared to Q3, that's down from 8.6%. And simultaneously, costs fell in clothing 1.1 versus, or negative 1.1 versus 0.9. So that's disinflation. And furniture and household services, we're also seeing disinflation with a negative 0.2 of 1% versus 2.5 in Q3. However, prices quickened in areas of alcohol and tobacco, so 6.6% versus 4.9%. Furniture outright in terms of 6.9% versus 4.9%. And communications also, we're seeing inflation increase at 2.2% versus a reading of 1.3%. Now let's round the inflation data out with the core trimmed mean CPI data. We saw a rise of 4.2% year on year. Now it is the softest rise since Q1 of 2022 after a 5.2% gain in Q3, but remained outside the central bank's target range. And this is where core needs to be, to 2 to 3%. Over to you, Evan. There's plenty to talk about here.
There is a boatload to talk about here. So first and foremost, I want to go back. You highlighted, and if you are watching this on the YouTube channel, I've got a table on here to show you what Ben said about what happened in the September quarter last year to what happened in the final quarter of the calendar year. That 5.4%, be aware it was actually downgraded when we got their last numbers. So it went from 5.4 to a final figure of 4.8. I'm going to come back to that. I want you to remember that number because it had a very, very influential sort of movement on the RBA for November and the Melbourne Cup number. But with the tobacco number that Ben highlighted, do not worry about that. Every half, they tend to move the tobacco number. There is a tax policy that's actually a health policy out there that the tobacco excise keeps going up. They are trying to stop you from smoking. So don't be surprised to see tobacco prices increase. And it only makes up 2.7% of the total weighting. So I'm not too concerned about that balloon. The other one is what's going on in insurance. We know about the horrible events that are going on, particularly on the eastern states with flooding, but it's not just for us, it's across the globe, that natural disasters are wreaking havoc on insurance premiums because reinsurance across the globe is ballooning all over. The hurricanes you're seeing in places like Florida and into the Gulf of Mexico, the fires that we've been seeing in parts of Europe and also in the US, that affects us because it means that the reinsurance costs that companies get handed through to us. So that is something that I don't think will change with regards to the inflation mix, that you are going to see insurance be a bit of a problem for you. And the other thing I'd always say on that is that do not, and this is a bit facetious, but I'm going to say it, never get in the way of an insurance company and a bag of money. And they, are very clear on that. So what I would say, and again, not advice, but always review your insurances across the board as often as possible. And I know Ben and I know the Empower Wealth guys will help you with that, but always look at your insurances, because there are ways to get ahead of that inflation figure that we're all having to absorb, and making sure you take away from it. So there, what I would look though, housing is moving in the right direction. It is moderating, although it's still high. I'd also point out very clearly that things like education and health are getting back to the norm. And I know that's a weird thing to say. Health and education tend to grow at a higher rate than the overall inflation. And I know you know that if you're a family out there, you'd be feeling that changes that's going on, particularly in the education system, the costs. There's also other policies that are going into it. But overall, it's getting back to a level that we saw in the pre-COVID world, that, health was moving at about 4 and a bit percent. Education moves normally between 3.5% to 4%. So these are positive things, because the services that Ben was alluding to, when we heard the governor talk about getting a haircut or going to the dentist, or it was just picked up by the wrong things. It's not what we're talking about. It's more about those businesses have been absorbing the increases in goods, had been absorbing the increases in energy, had been absorbing the increases in all those things. 2023, the dam burst and they just couldn't keep doing it. And they finally started to handing that cost through to you and me when we went and saw them. So that was the concern. And that was where services are always the thing to watch, because they're the last ones to move in price. They are. You can always see it. They're the last ones to actually start not only handing it through, so they peak later, but they were also the last ones to start moderating their price. But it's happening. And so as Ben said, the trim mean figure, the reason we talk about trim mean, it's the RBA's preferred measure. It's realistically another way of saying core. It strips out energy, it strips out food and all those other little bits and pieces. At 4.15, I want to go to 2 decimal places because it's been reported as 4.2. It's actually a little bit lower than that. The chart that matters is this one for those watching. The reason it matters is that trim mean inflation is ahead of the RBA's expectations, both from what they gave us in November 2022 and November 2023. And that in itself was fascinating, because they actually thought it was going to be about 4.5%, not 4.15%. So why that's exciting, why we have probably also talked about our consumption being slightly better, that we're slightly more optimistic, is because we know rate cuts are coming. And getting back to what we talked about before, rate cuts, not only are they coming, there's probably going to be more than what's been forecasted as well, because we're heading back to the target band of 2 to 3% at a faster, steeper rate than what the RBA expected.
Oh, beautiful summary. And that obviously then leads to what did the board and Governor Bullock do at today's RBA, 2-day meeting, remember?
Mm-hmm.
They basically met on both Monday and also today. What did they do? They kept the cash rate on hold, but certainly the messaging has shifted. So we probably have seen the last of any rate rises. And to your point, Evan, you believe that there's probably 1 or 2 extra that they put in there for good measure. And the benefit of hindsight, back to that number you were saying, the adjusted number in September. Do you want to talk to that quickly?
Yeah, and so that's exactly right. So we know they've put on hold today, and that's fine. And again, Michelle Bullock is probably leaving her powder dry, right? She's certainly a little bit, and has always been, more hawkish, as we call it, than her predecessor in Philip Lowe. But I've always believed that they probably have gone. I actually thought they'd gone too far originally. I thought they could hold at 3.85%. The inflation rate was showing signs of easing, that we knew the pressure that was coming on the household, the so-called mortgage cliff, which thankfully never eventuated and it was never going to. But that sucking out of the savings that we'd had during COVID was happening pretty rapidly. And we were showing signs that it was happening fast enough. So I actually thought they went an extra 2 times. But getting back to your point about November, they got spooked because the quarter figure for September was 5.4% at the time. So I understand they went on the data they had at the time, which now looks even more sort of overly sort of reactionary to the inflation figure. Because at 4.8 from the previous quarter of June, which was sitting at 5.6, is significantly different than going from 5.6 to 5.4, right? So that year-on-year figure, that Melbourne Cup looks like the horse bolted, excuse the pun, in the fact that they have panicked. And now they don't just have a tightening bias, they have a really strong reactionary break in the economy. And that's happening. You can feel it. Cost of living, about that. About your mortgage and where that's going. That inflation's coming back, which is good. So my view is that They probably didn't need to get caught up with a lot of the jargon that was coming from someone like the IMF or the World Bank, other pressures that were saying we need to have higher rates, the inflation rate in Australia is too high, you're not doing enough. The slow and steady approach they had taken was actually working. And I think they got talked into the extra one in November, and I actually think they got talked into an extra one in June as well.
So interesting point. I mean, obviously that's the benefit of hindsight, and at the end of the day,
Sure.
they had the data and that, so we can obviously always make those comments. I think, so the cash rate remains at 4.35%. What's your view in terms of when we see the first rate cut coming?
So I still think we're probably going to have to unfortunately wait to the second half of the year. I think the first one, if we're really lucky, will be July. But I actually think it'll more likely be what is now the end of August, and then possibly the Melbourne Cup being the second one. That is how I view it, for the point of view that they will again, they've already said it today, data dependent. Just get used to hearing that term, data dependent.
Yeah.
So they will have had half the calendar year of data to actually allude to them saying, okay, inflation's still moving quite quickly. It's likely that by June, the inflation rate on the year-on-year trim mean will be into the 3 handle quite clearly. It's probable also that at the moment, I actually think the unemployment reads are slightly behind where they are. I mean, there's anecdotal evidence that at the end of last year, there was a lot of redundancies that came through. There was a lot of unemployment ticking through. And you saw that in some of the data, and we'll come to that in a sec. But I think all of that is why come June, all of that data will be out. All of that understanding will be out. All of what happened at the end of last year and the start of this year will be in their hands, with them no other option really than to say, right, we need to start taking our foot off the brake. Because do remember, 2 rate cuts takes us back to 3.85%. That is still, in the RBA's book, restrictive. They need to get back to 2.5% to be at what they call their neutral rate. So
normalised rates, yeah.
It's still a long way away from being accommodative and therefore stimulating the economy. It's just taking a bit of pressure off the household and off the business sector than is currently there.
Yeah, I think your point to the fixed rate cliff is that it will be material if households continually can't cover through their savings, right? So as those savings are depleted, the longer that the rate stays higher, the greater the risk of having increased defaults in the marketplace and greater risk to the broader economy. So I think that's going to play to their mindset and their decision making, because we know that really that these types of changes have lag effects into the quarters, and if not even half years, in terms of before we start seeing them play out in terms of actual economic performance. So I think that's an important message. Let's talk to the unemployment rate now. We saw that Australia's seasonally adjusted unemployment rate stood at 3.9% in December. That's unchanged from the November reading, and that's an 18-month high and matched the forecast estimates. The number of unemployed individuals edged down by 0.8 thousand to a reading of 573.6 thousand, with those seeking full-time employment, jobs falling by 7.3 thousand to a reading of 367.7 thousand, whilst rising to for part-time by 6,500 to a reading of 196.7 thousand. So meanwhile, employment unexpectedly declined by 65,100 jobs and 14.2 million, missing market expectations of a 17.6 thousand gain and reversing from the 72.6 thousand rise in November. So full-time employment dropped by 106.6 thousand to 9.75 million, while part-time employment increased by 41.4 thousand to 4.41 million. Now, the participation rate, which I know you're going to talk about in a moment, decreased to 66.8 from a record high of 67.3 in November and below forecast of 67.1. Meanwhile, the underemployment rate was unchanged at 6.5%. And that's still 2.2 points lower than before the pandemic. Additionally, monthly hours in all jobs fell by 10 million, or 0.5 of 1%, to 1,926,000 in terms of monthly hours. So lots of moving parts there. How do you read that, Evan?
Yeah, lots of moving parts. So the way I read it, and again, if you're watching on the YouTube channel, there's a chart on screen that I've got here that shows unemployment that Ben obviously read out at 3.89%, so close enough to 3.9. Underemployment at 6.5%. Now remember, I said this before, but I'll say it again. Underemployment is the measure of unemployed plus, underemployment is those that are working but are looking for more hours. And then we've got underutilization. And this is the one that I really want to highlight. Underutilization is the combined number of the unemployment rate and the underemployment rate. Now, the chart I've got here has that on the right-hand side. If you're listening to it, what I want to point out, underutilization is at 10.3%. You have to go all the way back to 1989 to see that same level. So it shows you that even with all of the changes and even with the slowing in the employment market and the slight uptick that we're getting in the unemployment rate in October, November, December, that the market here is still booming. We have got an employment market that is incredibly tight. And we keep hearing that. It also gets back to the point that, yes, cost of living is there. Yes, we know inflation's there. Yes, we know that you're eating into your savings. But your employment status, you feel pretty secure. Like you actually genuinely feel relatively secure in your employment, or if you were to lose it, that you think your ability to find a new job is actually quite high. And that's what this is telling you. That's why, for me, the most impressive thing about Australia over the last 5 years, including 2018 to where we are now, so through COVID, is our employment market and our employment possibilities have never been stronger in terms of where we sit. Well, that's why we're such a lucky country. And this chart is telling me that, because also the gap between unemployment and underemployment is narrowing to levels that we also haven't seen for almost 20 years in terms of where it's been. Yes, there's an ugly spike in COVID because the ABS had no idea how to actually completely deal with what was going on. Nobody did. So if you actually smooth that out and you have a look at where that sort of gap is sitting, we are knowing that we're also not having to go out and search for more hours, despite the fact, as Ben said, for the last month, it is moving up. Overall, the employment market in Australia is an absolute white knight, and I think it should be championed to the nth degree, because it also means you're eating into your savings, but you know that you're still making enough money to live through what you've got, pay your mortgage, pay your rent, maybe a bit tighter than you hoped, but overall you're not in a scenario where you're super stressed and that you're actually finding yourselves in a point of panic because unemployment's starting to balloon out, the economy's starting to slow down. That hasn't happened, and that's why there's pros and cons to that, but I would take the pro, which is that we are dealing with a scenario right now better than anybody could have forecasted, and that's true. Nobody's forecasted this. We are going to have a soft landing, fantastic, and that the overall impact will be slowly mitigated out through 24, 25, and 26 of slowing economy, higher rates. Thankfully, we're not going to get the unemployment boom, excuse the pun, that could actually be a negative as well.
And I think what you're talking about there in terms of the benefits of what you get of a tight labour market is wages growth increase. And that's a nice little segue into, obviously, Australia's seasonally adjusted wages price index advance by 4% year on year in Q3 of last year, after a 3.6% gain in Q2, compared with market expectations of a 3.9% reading. Now, this was the highest reading since Q1 of 2009, as wages in the private sector grew 4.2%, the most since Q4 of 2008, whilst those in the public sector were the highest since Q2 of 2011 at a reading of 3.5%. In original terms, the main contribution to the growths were accommodation 5.5%, healthcare and social assistance 4.9%, arts and recreational services 4.6%, manufacturing 4.4%, transport, postal and warehousing 4.4%, retail trade 4.4%, construction 4.3%, administrative and support services 4.3%, and mining 4%, and electricity, gas, water and waste services 3.9%. So, yep, we've had inflation and wages haven't quite kept up with that, but as inflation goes down, we get to keep those wage gains, and that means that our disposable income ultimately buys us more. So broadly, it's a good news story there.
Yes, it is. And although some people argue that there does have an inflationary effect, that our wages are growing at some of the fastest rates, as you alluded to, for many, many decades, I would point out that again, the overall improvement in the economy is actually more important. So it does mean that going forward, it may give Michelle Bullock a little bit more room to say we're not cutting rates yet, but she
Yep.
knows she's going to have to. Not only that, as Ben pointed out, if you compare wage growth to the inflation rate over the last 3 years, it's your real wages actually haven't grown. So you know that, and that's something she has to take into consideration. So I think this is a good thing. It will be interesting to watch what happens at the end of June, start of July, when we do start to see what the minimum wage will be increased to. Being aware it's increased 17% cumulatively in the last 3 years. It took 8 years before that to get that kind of increase in terms of it. So all things being equal, it would suggest that we're going to have some form, it's probably between 910, maybe even as high as $940 a week will be the minimum wage, going up from about $870 now. So take that as you will. It is good. It means people's pay packets are better, their security is better. It will have a mild impact on inflation, but not a level that's going to drive inflation back towards what we saw. Not I'm not going to use 2022 because that's not a fair figure, but into the mid sort of 5 handles of 2023, it won't do that.
So let's talk about what it means for the consumer, and ultimately from a consumer sentiment and confidence point of view. We've been in the doldrums, right? I mean, ultimately we're getting readings as poor as what we've seen in previous recessions and through, sort of the global financial crisis. But we saw the Westpac Melbourne Institute Consumer Sentiment Index for Australia fell by 1.3% to a reading of 81 in January from a reading of 82.1 in December. So it certainly remains in a pessimistic level for nearly 2 years as a surge in the cost of living and higher interest rates continue to dominate sentiment. So that's the product of cost of living, high inflation, and obviously 13 rate rises. That's what it will do for us. So that's what we do understand. It's still, based on the last good inflation read and potential expectations of a pause in interest rates or even potentially a cut, I suspect that consumer sentiment story is going to improve over the next 12 months. But I want to move into retail sales as a consequence of that. And this is about that sort of wealth effect and how much disposable income that we've got available for. And we saw a shocking number in terms of the retail sales. So I'll get through that data and then I'll get you to make a general comment, Evan, in terms of what's happening with the consumer in Australia. So we saw retail sales in Australia declined by 2.7% month over month in December. Now, that's the worst than market forecast of a reading of 1%. So it was miles out. And that was after a downwardly revised 1.6% growth in the previous month of November. Now, this is the steepest drop in retail trailed since August of 2020 as consumers brought forward some of their December spending to November to take advantage of the Black Friday and the Cyber Monday sales, etc. Sales were down for most retail industries, namely household goods retailing was negative 8.5% versus a positive 6.5% in November. Department stores negative 8.1% versus a positive 4.1% in November. Clothing, footwear, and personal accessories negative 5.7% versus 2.2%. Cafes, restaurants, and takeaway food negative 1.1% versus negative 0.2% of 1%. And other retailing negative 1.1% versus 0.8% of 1%. So a shocking set of numbers there for the retail sector. Food retailing stayed muted at 0.1% versus a flat result. Retail turnover decreased across the country with large falls in all states and territories, the majority down by more than 2%. Throughout the year to December, retail sales grew by 0.8%, and that's the least since August of 2021 after a 2.2% rise in November. Now, what this tells me, these are shocking numbers because of our population story as well here, right? Yeah. So population plus inflation meant that the real reading of retail sales is shocking. And that should give confidence to Michelle Bullock and the team there to sort of say, we've got to be careful that we don't overcook the economy with keeping rates too high for too long.
Yeah, and I'd agree. So I also looked at, I mean, at the moment, the data is being questioned because, the introduction of, as you alluded to it before,
Yeah.
Ben, about Black Friday and Cyber Monday, what that's actually meant to this data, because they put seasonally adjusted numbers into it and blah, blah, blah. So realistically, you need to look at October, November, and December together. So you look at the 3-month blended average. It's a contraction of 1.5%, give or take. And that in itself should say a lot. It gets back to my point before about being spooked on, Melbourne Cup Day. That rate rise is well and truly now being shown as overly excessive, considering that spending was already declining quite strongly and quite rapidly. It also shows, and it gets back to your point about the consumer confidence number, that the family finances, not only are they being constrained, we are now making conscious decisions about how we're spending. That is clear from everything we're doing. Going out, you just saw that with the restaurateurs and takeaway. We have cut that out of our lives. We have started to cut out tourism. We know that as well. All of those sort of, again, the inflation psychology, that's the term that the RBA love to use, is here. We are now very aware that inflation's a problem and that we've changed our behavior. And it's clear in the economics that we are doing that. And so this is a big, and I agree with you, a big wake-up call. Brad Banducci also, and this is the head of Woolworths, he's actually waiting for this month. He thinks that once the end of back to school has happened, that their overall business will see a significant change in consumption as the household tightens even further. So being aware that not only is the trend there, about a 1.5% quarter-on-quarter decline in retail sales, big retailers think it's going to get even stronger in the first quarter of this calendar year. So the reason I actually see that as a good thing, I don't like to say that because retail is an absolute lifeblood of this country. It does show you very strongly that A, interest rates work, B, that we are making the right decisions that the RBA wanted us to do, and C, rate cuts can happen sooner rather than later. So that's the way to look at it in terms of it is. Doesn't mean there's going to be, pain not felt in the first half of this calendar year, but this all shows me that the levers that we have had to go through, the pain that we've had to go through is here. It's working, as hard as it is to say, which means the sooner it starts working, the sooner it can be released. And that's the silver lining to this, despite very marginal silver lining there, Ben. I do apologize, but it is there. It is there despite retail sales showing this. And as I said, it is clear that the household in this quarter will probably, again, batten down the hatches, pay off their Christmas bill, pay off their overall bills from the end of last year, and reassess where they sit once they know where the household now is, that they've got through that spending period and they're back to, inverted commas, normal, traditional spending patterns of a day-to-day living.
Well, it sort of makes sense in terms of essential versus discretionary spending and those staples that Brad's sort of looking to try and find, because the way in which I read it is, it's very hard to get a read on the summer holidays and sort of what's been happening. So that is really going to show up in terms of just how much those households are hurting. And I've seen some of the data coming through in terms of what people are buying in terms of movement to home brands and the cheaper goods. And, obviously cheese and dairy costs have gone, quite high. So people are being more selective about their dips and chips throughout the course of the summer break and so forth. So it is going to be interesting. And that to me just says just basically how much households are going to be hurting. Look, good segue over to, obviously business confidence and conditions. So we'll do a quick summary of that. And then we'll spend a bit of time in terms of making sure that we sort of bring out what we see the themes are and those sort of more important things for the economic drivers. And then we'll talk about property, and then we'll close it out with our predictions in terms of where we're going to see how many rate cuts as we're potentially going to see as part of this outlook. So here we go. So in terms of the National Australia Bank's confidence index climbed to a -1 in December, and that's a downwardly revised -8 from the previous month. It was the third straight month of negative readings, but the softest figure in the sequence, supported by a pickup in the mining and retail sectors. So if we've got a chart there as well that tells this story. Meanwhile, business conditions slowed but stayed above the long-run average, 7 versus 9 in November, and sales eased 10 versus 13, whilst profits were sustained 6 versus 6, and employment eased slightly 7 v 8. Now, those leading indicators were mixed. These are the ones we need to be looking at, right? This is a story about inflation and in terms of employment intention. So we saw forward orders easing, -3 versus -4, and capacity utilization fell 82.7 versus 83.6. Importantly, labour and purchase costs growth eased, whilst retail prices dropped sharply to 0.6%, the lowest since late 2020 from the prior 1.8%. So if I wanted to quote the chief economist, Alan Oster of NAB, he says the survey shows that economic growth has eased considerably by the end of 2023 after performing better than expected for much of the year. And this slowing is beginning to translate into improvements in inflation. I think he summarized that beautifully in the sense that as demand falls, pressure on prices start to slow down. That psychology of buying anything at any price starts to be removed. And then we start to see that inflation story and that overall slowing of the economy. And I think that makes for a good story there. So I want to just sort of take away on some of those big key takeaways. So we've definitely got a slowing economy on the back of disposable incomes being eaten away, both from a mortgage repayment point of view, as well as a rental story with those higher rents. We're also going to see, and we haven't sort of touched on this yet, but we'll do more about this in the first quarter of the year as we look at the immigration story. So population growth is slowing. So that means obviously the consumption, the size of consumption for the number of population in the country is going to slow. And then we're going to sort of look at, those triggers of what's going to move the interest rate story. So, you've got a nice little graph that you want to talk to here, Evan. And for those who are on audio, just tell us a little bit about what we're talking about here when it comes to, this chart that we're looking at.
So just what I wanted to show with what's on here, this is the FOMC dot plots, and this is the Federal Market Open Committee. They have a very, very open dialogue with the community. And so every one of the dots on this plot is a member of the board. So that's what this is. Again, for those of you listening out there, their expectation as a group that by the end of this year, the US federal interest rate, so the federal funds rate, which is a band, is going to be what we call the midpoint, will be about 4.625%. So that would mean that they want rates between 4.5 and 4.75%. So significantly below where it is. And that's there. What's really Kelly, and why I just wanted to show this chart, is that it also shows the market's expectation from their last meeting to their new meeting. And so the expectation from the last meeting was that by the end of this year, rates in the US was actually going to be about 3.75 to 4%. That's now moved up to 4% to 4.25%. And the start of when those rate cuts happened has moved from being March to June. So again, it just, all of those confidence numbers, all that what Ben's been alluding to is just easing back. And that therefore means that we are going to have to accept, and I think we know this, that the first half of this calendar year will be different to the second half of this calendar year. And that expectation is starting to get rooted in consumer confidence, business confidence, and everything that we're doing, that it'll be a tale of two stories very, very clearly. And the Fed has probably actually put that mode now almost into a certainty.
And then obviously what that means for the Australian economy is we are watching in terms of, and we're a market player in the global economy as well. So yes, we are definitely seeing what's going to be happening there, as well as looking at our domestic story. So we're basically putting bookends on the conversation that we've just had with you today. The first bookend is that domestic demand. And then the other side of it is obviously that global demand in terms of the cost of money. So as the Fed starts to think about moving those down, that has a positive impact in terms of equity markets, not only offshore, but also here in Australia. We saw basically a Christmas rally in both of those particular areas as people started to think beyond the higher inflation and starting to see a world where inflation starts to get lower. And that has a wealth effect in terms of the Australian population. So again, the double-edged sword on that, which is what Evan and I want to highlight here, is that can also mean that inflation, getting that, walking that last yards in terms of getting inflation inside that target range could be a challenge. And that's why the story of unemployment and exactly what businesses are doing is going to play a role in that, and that's going to be led by the demand for the consumer. So I think that's a really nice way to close out the bookends on what has been a significant deep dive in the first part and our first show for the year.